So let's have a look at some typical exit strategies. As we've discussed, exit strategies are vitally important because they are what is going to get the investor or the lender their principal back. As we've seen about mitigating risk during the term of the loan, it's all about ensuring that the investor lender gets their periodic, typically monthly, mortgage payment of the interest. So they're getting the return on the investment. But an exit strategy is designed to ensure that the investor lender gets their principal back. And this is often a misunderstood point for, especially with those new to the industry. Again, it's easy to write a check and give someone some money. What we need to do is plan for the future and have the investor lender receive that money back. And the investor needs to understand the different types of exit strategies. There are a lot of different factors that affect an investment's overall risk profile, but the exit strategy is one of the most important of them all. This is the strategy that is planned to be used to get that investor lender's money back. So the different types of exit strategies tend to include selling the property at or before the end of the term. Now, two things to think about here. We're listing the possible exit strategies, and some of these will be, you might be thinking, well, how is selling the property if the purchaser or the owner sells the property at or before the end of the term? This is an exit strategy designed to advise the investor lender of how they may be getting their principal back. So this is an exit. And then when we look at all of the different exits, we can then advise the investor lender on which strategy we should be recommending or what we think will be happening. So the first exit to talk about is selling the property at or before the end of the term. The investor needs to be aware that this may happen. And if that's the case, then we need to ensure that there is a process in place so that the loan doesn't hinder the owner's ability to sell that property. There is an option to renew at the end of the term. That option will be the lender's, and if the borrower wishes to do that, that's up to them as well. But we need to talk about this in advance of lending at the beginning. What is the investor lender's plan at the end of the term? Are they going to most likely want their money back, or would they be interested in renewing if everything is going along and there are no issues? That's an option. That's also an option that we need to discuss with the borrower a few months ahead of the renewal date. Could refinance with another investor or institutional lender during the term. So in other words, if the mortgage is partially open, so open with a penalty attached to it, which in many cases, we suggest that an investor lender uses that approach, have it partially open, but there's a penalty. The investor can say, you know what, I want a closed mortgage, so you can't prepay the mortgage during the term, you can't break the term. But generally speaking, what we're trying to do here is a win-win for the investor and the borrower, so that if the borrower decides that they want to refinance with another lender because their situation's improved, then it's in everybody's best interest that they're able to do that. And hopefully we have other clients that we could take the investor lender's money and put that into a different mortgage. So we need to be able to suggest to the investor lender that if we're going with an open or partially open mortgage with prepayment penalties, what those penalties may look like, and typically the timing behind that. refinance with an institutional lender at the end of the term. That's a fantastic option for the investor lender, especially if they don't have any intention of renewing the mortgage. And again, this is something that we can talk to the investor lender about when we are initially proposing the mortgage as an option to them. We discuss the fact that the borrower has a first mortgage that's coming up for renewal. And now this is when it boils down to an analysis. We look at the borrower's first mortgage. What is their current loan to value? What does the market look like over the next 12 months? When is that first mortgage coming up for renewal? So if we're trying to match the two, it's helpful to match the two if there's a possibility to bundle the two at the end of the term. So if we have an 85% loan to value first mortgage, or an 80%, let's say, and we did a 5% second, then when it comes to refinancing the first mortgage with an institutional lender, we probably can't do that. So unless the property value has gone up. So that's why we need to look at all of the different scenarios. If the market is flat or decreasing at all, then the chances that the borrower is going to be able to combine the first and second mortgage over 80% is pretty much non-existent. We need to prepare the investor lender for these different types of possibilities. But if, for example, it's a lower loan to value first mortgage, we've gotten the borrower a high interest rate second mortgage because they didn't want to break the first mortgage and pay a penalty to refinance, we can then arrange for the term to coincide with the end of the term of the first, and then we can facilitate a refinance that bundles those two mortgages in together. So these are something that we should be talking to our investor about. Belshid, to some extent, we should know the exit strategies of the borrowers from the current loan. Yeah, and that's one of the other reasons that, none of what we do is in a vacuum. When we're brokering a transaction for the borrower and a potential investor lender, what we're doing is using the information that we've gathered from our needs assessment with the borrower. And some of these questions that we ask, what are your intentions over the next 5 years? Do you anticipate that this house is going to be suiting your needs over the next 5 years? And so on. Those are helpful questions to assist us in then speaking to our investor lenders. That way we can present them with a full scenario and give them some options. That's always one of the most important tasks that we perform, is knowing the situation fully. That's why the needs analysis, the know your client form, as much information as possible that we can gather from the borrower needs to be shared with the investor so that we can all make, sorry to say this again, an informed decision. But we have to be able to make the most informed decision as possible. And if you always keep at the back of your mind, if that helps steer you in the right direction, what information should I be providing to any party, any client of mine? The answer should be as much information as possible so they can make an informed decision, as much of an informed decision as possible. Now, there's also the potential to have to use a default remedy if the borrower defaults. So that would be an exit strategy. And that's where we look at the current loan to value and the options for refinancing with another private lender who may have a higher risk tolerance. There are different opportunities here, but we may have to use a default remedy if the borrower defaults. So I would suggest that we have a conversation with the investor lender at the outset, especially if this is a new investor lender. We have a discussion with them on the potential outcomes, the potential exits from this transaction. And one of the exits being a default remedy may impact their rate of return, and it may impact if they receive their entire investment back. It may delay the ability for them to get their money back. So we really need to have a conversation with the investor lender in regards to, if they stop making their mortgage payments, these are our potential exit strategies, and ensure that the investor lender understands that and is okay with that possibility. It again goes back to understanding the risks during the term of the borrower being able to make their payments. It's not enough that we say there's enough equity in case something goes wrong. We need to illustrate to them, this is what may happen if something goes wrong. As long as you understand that, then we're good. And that's what we want. We want investor lenders who are all in, understand what they're getting into, and hopefully in their own personal life, they have enough of portfolio diversification that this is an acceptable risk for them. But these are the conversations we need to have. I've always thought myself that I don't want an individual investor lender to be upset if something happens during the mortgage life. I don't want them to be upset with me to the point that they didn't know that something might happen. Again, we're all adults. We can make our own investment decisions as long as we have the information to make an informed decision. We can also assign or sell the mortgage. So that's an option if, for example, during the term, the investor lender needs their money back. There's the possibility that we may be able to sell the mortgage. We need to be able to discuss with them options in regards to selling, that there is no secondary mortgage market. It will take time, and they will not, if we have to sell the mortgage, likely earn as much interest as they anticipated. In fact, they may lose some money if they have to sell the mortgage at a discount. We don't talk about the mortgage finance part of it in this course, where we would talk about, if I have a $50,000 mortgage outstanding, it's 12%, it's a second, and then I want to sell it to somebody, how would I price that mortgage to make it attractive for somebody to buy? But that is the process. So if you're interested in learning more about that, there's a lot of information out there on how to discount a mortgage to sell it.